Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching IndianOpen. Let's go straight to the headlines. Brent crude price hovers near a 4-year high after OPEC nations stop short of hiking production. Some traders say they can't or they expect crude to touch the $100 a barrel mark. Yes Bank board meets today to decide on the future course of action after RBI sets a January 2019 deadline to find a replacement for Rana Kapoor. Canara Bank moves NCLT against GTL Infrastructure, claims non-payment of dues worth 541 crore rupees. And Havas Financials IPO opens for subscription today. The company plans to raise 1,734 crore rupees through the issue. Well, let's first take stock of news around the world and then we talk of things that are impacting India as well. So, political uncertainty dragged the US market slightly lower. I think there's some conversation in the US around the US Deputy Attorney General Rod Rosenstein not continuing and or what would happen. So that led to a bit of a pullback in the Dow Jones numbers. That aside, it was a fairly placid day for the US markets. The good news, if you can call it good news amidst all the uncertainty around trade, is that there is a new US and South Korea pact, and that spurred hopes for NAFTA as well as China deals. At least the bullish names would want to look at it that way. Whether it actually becomes that or not remains to be seen. But there is a new US-South Korea pact as well, a trade pact, which might be beneficial for both the countries and maybe for overall trade sentiment as well. Keep in mind, the FOMC two-day meet begins tomorrow, and that's something that people will be watching out for as well. So by tomorrow late evening, we'll get the decision from the FOMC, and that'll be interesting to watch out for. What about our markets? Well, the trade setup and the global and the local factors all seem to be against the bulls. Brent crude northwards of $80 a barrel, I think trading at somewhere around 81 or thereabouts, and this remains now a key monitorable. Remember, we kind of slipped in the backdrop amidst all that's happening in the Indian bond markets and or the corporate bond markets and the pressures thereof. But this remains the big elephant in the room, and it's rearing its ugly head again. So let's wait and watch. It's had its impact already. Rupee dived about 43 paise to close at about 72.63. Yields, which had started cooling off, hardened for 2 days on a trot as well. So all of that is now back in the driver's seat as the key monitorable. Interestingly for our markets, this expiry as well, 11,000 somehow as a strike remains the highest OI in the current series. If you just look at the open interest distribution, one would have thought that because we slipped sub 11,000 yesterday, is there a bit of unwinding? But the 11,000 strike still remain firmly in place. So whether or not the traders manage to defend it, and whether that means that we will shut shop in and around these levels closer to expiry, or if the markets were to drift lower during the course of the day, does this lead to significant unwinding and therefore pressure on the markets? I think that's one key monitorable, to be honest, from an expiry perspective. 3 days to expiry, I think it'll be interesting to see what happens there. Yesterday, amongst all the rate sensitives fell. So while we've seen the banks and NBFCs fall, yesterday it was a turn of the autos as well. The Nifty Auto Index was amongst the worst performers. In fact, it's the worst drop in the Nifty Auto Index since November 2016. And all the large cap names, be it Eicher, Tata Motors, Hero MotoCorp, all of them suffered a lot of losses in trade yesterday. Flows too from the FI side were negative. So the FI number was minus 524 odd crores. DI is pumped in about 1,500 odd crores, but difficult to envisage really high flows coming in from the FI side and giving support to the market in the current scenario. So the trade setup does look weak. We may start off flattish today. The SGX Nifty indicates that we'll have a start which is marginally in the green, but actually a very flattish start. So in and around the 11,000 mark. Let's see what happens during the course of the day. The world markets too. I think if you just look at the Asian screen, a fairly flattish day for most markets. What are the stocks to watch therefore? Yes Bank, the board meet today to decide the course of action post Rana Kapoor's term cut. This will be an interesting one. It suffered a lot of losses already. Let's see if there is more in store today. Yesterday was a flat day. SBI Life Insurance could well see some ticks down. BNP Paribas Cardiff may cut stake in the company to comply with the minimum shareholding norms. So let's wait and watch what happens thereof. And lastly, HFCL, they've received a 569 crore order. It's a large order for a small company, but in a scenario like this, I don't know how much of an uptick it brings in. Remember, ITD Cementation, yes, they got a large order. A stock rallied a bit in a bad market. Let's see if the same happens to HFCL today. However, let's tell you what's lined up on First Word on what promises to be a flattish start. Any compromise between the US and China on trade may have to wait till the midterm elections in the United States. Bloomberg's Tom McKenzie will tell us why. Then the NBFC pack and the heavyweights have been battered in trade as markets remain nervous of the liquidity situation. Shraddha Johnson to put the valuations into perspective. Finance Minister Arun Jaitley, of course, will meet the heads of the PSU sector banks today, and that's important from a financial perspective. Nikunj Ohri will tell us what's on the agenda. A lot of working for Kaveri Seeds. Nikki Mirchandani will tell us what might have helped the company rise 25% from recent lows in a market like this. And then, did you know that Tatas, Birlas and Mahindras have indices of their own on the NSE? Jayesh Kelani takes a look at how they have performed. The first speed, of course, is global. The world's two largest economies are digging in for what could be a long and bruising trade war. The Trump administration has slapped tariffs on $200 billion worth of Chinese goods yesterday. China has responded with duties of its own on $60 billion worth of US imports. This means that talks are off the table for now, especially with the midterm elections in November, which has the Trump administration on the edge. Tom McKenzie of Bloomberg News reports.
Certainly the view increasingly here in Beijing is that there's not going to be much traction on any negotiations around trade until after the midterm elections. And that's one reason why Beijing pulled out of these proposed talks that were being lined up for this week. And as you allude to, they are also, the Chinese, building out their defences. They're planning additional stimulus, we hear, to try to offset some of the pain. And they need to be doing that because, of course, Trump has said that he would hit back with additional tariffs on another $267 billion worth of Chinese goods should China retaliate, which he has done, of course, slapping tariffs on $60 billion of US goods. So it looks like both sides are becoming more entrenched. We've heard from Bloomberg Economics, by the way, our chief economist, Tom Orlick, writing a piece saying that for the moment, the advantage is with the US, largely as a result of that tax cut fueling a growth or tick up in the US equities, but that calculus or that dynamic may change, particularly if you start to see the tariffs eroding some of these corporate profits in the US, if you do see the political landscape change after the midterm elections, and if you do see an impact on US equities, then potentially the advantage could then switch to the Chinese. But for the moment, it is the US that is in a strong position, according to Bloomberg Economics.
Well, let's see. This is a moving piece, but frankly, if you just step back and then try and take a look at when could this possibly get resolved? Yes, with the midterm elections coming in, maybe it's in the political interest of Donald Trump to keep this issue alive and kicking. So maybe everything happens only post these midterm elections. However, that's the global piece, and the global piece will stay alive tomorrow and day after as well with the FOMC meet. But back home, we're seeing the rate sensitives getting battered. Now, NBFC stocks have stayed in the red on Monday as well, despite the regulators in the finance ministry trying to assure the credit markets and its heavyweights and the heavyweights have had to bear the brunt of this recent sell-off. Now, the question mark also is whether the finance ministry and the RBI and the SEBI putting out these notes didn't have the desired effect, in fact had the negative effect, because people thought that, oops, what if there are really some concerns? So what has all of this done to the kind of corrections that these stocks have seen and the valuations as well? Shraddha Babla is here to take us through the details. Now, Shraddha, the ILFS default has been the main trigger, but the fact that there are some other bond sales that have happened at higher coupons haven't helped, and the NBFCs have borne the brunt.
Absolutely, and how, Neeraj, because if you look at the share price performance, especially for housing finance companies over the last 5-day period, you will see a double-digit price erosion for most of these stocks. These are the top 5 housing finance companies in terms of the market cap, not just housing finance companies. Even if you look at the other NBFCs, the asset financiers, especially in the month of September, it's double-digit losses or 20%, in excess of 20% gone for all of these companies. companies, 22% gone for L&T Finance and Edelweiss as well. So what has this kind of correction done to the pricey valuations for some of these companies? Has that really brought down the valuations? Well, not necessary. Now, if you look at the current price to book valuation of housing finance companies and compare it with the 5-year average, you will see that in case of Indiabulls Housing Finance and Diwan Housing Finance, which actually bore the maximum brunt of the sell-off that happened on the back of DSP selling one of the bonds at a higher discount, you will still see that they continue to trade at a premium of 12 and 5% to their 5-year average price to book value ratios. Even if you look at the NBFCs, while some of the CV financiers like Mahindra Finance and Shriram Transport has seen some valuation correction, but the likes of Bajaj Finance and Edelweiss still continue to trade at a premium in excess of 50% to their 5-year average book values as they have re-rated. So what are the key challenges for NBFCs then? One, the debt markets are turning risk averse towards NBFCs, and what that means is that it is going to impact the funding requirements of these NBFCs and increase their cost of funds, which means that it will impact their net interest margin. So according to analysts, funding costs are not necessarily the issue for NBFCs at this point in time. Liquidity is not the key issue for NBFCs at this point of time, but it's the cost of funding. Now, the higher funding costs will hurt margins, like I said, and even if you look at the recent past, the share of the market borrowings for these NBFCs had risen to nearly 45 to 60%, especially in the case of housing finance companies. What it also said that the strong growth that has been priced in for these NBFCs, continued strong growth, that would actually require continued funding, and in this environment, if that were to sort of get impacted, then it would mean that there would be some earnings estimate declines, and the multiples could also stay sluggish for some of these NBFCs, and probably markets also have used this as an excuse to bring down the valuations to more reasonable levels. So that's as far as NBFCs are concerned. Now, what Morgan Stanley has said is that they prefer banks in this rising rate environment, especially given that they have a stronger liquidity owing to their deposit base. And additionally, they've said that if NBFC growth were to slow down, the competition in retail loans will actually come down, which will be beneficial for margins of banks. Kotak has taken a contrarian view to this, and they've said that they see a lesser impact on well-run retail-focused NBFCs, and they see adequate funding support for NBFCs which have a strong parentage. So whether you talk about LIC Housing Finance, a Rural Electrification Corp, or those coming from big business houses like your Mahindra Finance or your Bajaj Finance or your Aditya Birla, they've said that the underlying business trends have continued to remain robust over the past few quarters for these NBFCs, especially in segments like CV financing, retail housing and rural auto. Hence, they have chosen to look beyond the near-term volatility, and they see opportunity to find value at least in some stocks. But Neeraj, clearly it's a market for the brave hearts right now.
It is. Shadab, just one follow-up. There is also a lot of conversation around how some of the short-term maturities positions for some of these NBFCs might be up for renewals at certain pockets, and that the NBFCs might find it difficult to roll over at the current rates, but we'll have to do it at higher rates, and that could be weighing in heavily on some of the others as well. It
could, and all of that boils down to the impact on net interest margins ultimately, Neeraj. But overall, analysts say that's a near-term issue because largely they don't see that impacting the fundamentals of any of these companies, especially those having a strong parentage. So yes, near-term impact on NIMs definitely, especially for the likes of, say, a PNB Housing, for example, where they have that asset liability mismatch in the near term.
Yeah, I think people are only bothered about the short term right now. The long term is firmly some time away. Thanks, Shraddha. Thanks for putting that into perspective. Well, so that's really all that you needed to know about NBFCs and what the current valuations are. Really, when you're looking at NBFCs, don't just look at the fact that the price has fallen from X to Y or Y to X as the case may be, but more importantly, even after that, what is the current valuation picture for some of these? Okay, speaking of banks, NBFCs, Finance Minister Arun Jaitley will meet public sector bank chiefs today, while stressed balance sheets and rising NPAs will take center stage. The government is also expected to take note of the 11 state-run lenders put under the prompt corrective action framework. Very important meeting. Nikhil Johri sums up the agenda for us.
Finance Minister Arun Jaitley is going to chair a review meeting of public sector banks in New Delhi today. On the agenda are a host of items ranging from credit offtake in the economy, priority sector lending, and the measures that these public sector banks have taken to improve their recoveries from non-performing assets. Remember, public sector banks recovered about 36,550 crore rupees in the first quarter of the current financial year, which was about 50% higher than the cash recoveries made in the same quarter of the last financial year. There's also likely going to be a discussion on measures that public sector banks have taken to come out of the prompt corrective action framework of RBI and the steps that these banks are taking to come out of RBI's PCA framework. Remember, there are about 11 public sector banks that come under RBI's prompt corrective action framework. This meeting also comes in the backdrop of a major announcement made by the government to merge 3 public sector banks, that is Dena Bank, Vijaya Bank and Bank of Baroda.
Well, I think this is something that we'll be watching out for as well. So let's wait and watch. During the course of the day, we'll get some announcements thereof. Well, while amidst all the bad news, there are some things that are going on for select companies. There are a few defensives which have gained, and there is a lot going for a particular company within that agri space, which is Kaveri Seeds. The government's new minimum support price has put more money in the hands of the farmer, and that is just one of the factors aiding the seed company. The stock has risen about 25% from the recent lows after a bunch of investors, including Monish Pabra and some of the others, have increased their stake in the company as well. So what makes Kaveri Seed the new darling, if I can call it that, for select investors? Nikki's trying to put together an analysis. Nikki, good morning.
Hi Neeraj, I'm going to start off with what the company is all about. It's a producer, processor and the marketer of hybrid seeds for crops. It's amongst the top 3 companies at in the entire top seeds company space, and it ranks 5th probably in the space of maize hybrid and pearl millet. If you look at the proportion of shareholding overall, cotton segment demands a good 15%, maize stands at 10%, and the hybrid of the overall market share, the company occupies 4% there, and in the millet segment the company occupies a good 8%. Specifically, why we are talking about this company today, well, Pabra Investment Fund entered the stock back in May, picking up around more than 1% stake, and back in 3-4 months until now they have scaled up their portfolio entirely to 9.48%, making Kaveri the 3rd largest investment in terms of the amount it has in its portfolio. Definitely worth a mention there. If you look at what's really working for the company, given the government advisory, the company is trying to reduce its dependence from being a cotton oriented company to non-cotton segment. It's trying to reduce that percent, which has come down from 65% of the revenue that we saw back in FY14 to around 57%. So there is a steep reduction there that you've been witnessing in the cotton segment. Also, if you look at the balance sheet position of the company, it's a zero debt, high cash rich company. Look at the financials there, 120 odd crore that we saw in FY12. That scales up to around 590 odd crore. So clearly has a lot of room for organic as well as inorganic expansion out there. If you look at the ratios out there, well, that's a kind of healthy kind of ratios that we're looking at, given the sales CAGR for around 5 years period stands at 13%, profitability stands at around 16%, margins have risen in the span of 5 years to 20 to 30 odd percent, definitely working well for the company. If you look at the distribution network of this 4-decade-old company, which has a pan-India presence, around 15,000 direct as well as indirect distributors out there, 200 plus employees, which is present across 15 states. So clearly some integrated house out there, 26 warehouses and a space of more than 6 lakh square feet out there. The only thing, the other criteria also which are working well in this company, the company is expanding into new geographies and products to reduce its dependence from cotton to non-cotton segment. Also, it is belongs to an industry which has high entry barriers. MNCs are seen exiting this business, again a larger market share pie coming in company's kitty, and also gives out healthy dividend along with the buyback program, which is working well for the shareholders. Also, if you look at the 2 areas of concerns that we have spotted out so far in the company, execution delays, it's a cause of concern given that the company is foraying into new geographies and launching launching new products. Also, we are seeing some amount of concern coming in from reopening of IT and SEBI probe. Now, IT probe happened back in January 2018 with regards to the taxation concerns of the company, and SEBI probe in 2016, given that the independent auditor was asked to do a forensic audit report on the company. They haven't heard about those investigations until now, but a reoccurrence or reopening of any of these judgment on the probe could be a bit negative for the company.
Okay, Nikki, thanks a lot for that. And of course, these probes and the outcomes thereof will have a bearing as well. Thankfully for Kaveri seeds, the monsoons seem to be have a slightly subpar, yes, on a countrywide basis, but in key markets have done okay, and that should probably augur well. Thanks, Nikki, for putting that into perspective. The 6-month performance, 25%. Ask anybody if they've taken this, and they would have taken this with both hands in the current calendar. Okay, the last piece on First Word today. Did you know that there is a Tata, Birla and a Mahindra Group index on the National Stock Exchange? The country's largest equity exchange started these indices in December 2015, tracking the performance of the individual groups' performances. Jayesh Kilani joins us now for more details. Now, Jayesh, interesting. How do these indices work?
So Neeraj, just like the Nifty small cap or any other sector indices, isn't it cool that we have a Tata index, a Birla index and a Mahindra index, which is officially provided by the National Stock Exchange of India. And with the use of some coding and the Bloomberg, I was able to chart how these indices would have performed over the course of time. That's the 2018 performance, and what you actually see is the white line, which is the Nifty Mahindra index, the yellow line is the Nifty Tata index, and the blue line is the Nifty Birla index. Now that one has in fact underperformed to some extent, giving loss of about 17 to 18 odd %, but the Nifty Birla, Nifty Mahindra and the Tata index, those are neck to neck in terms of the performance. They have risen anywhere between 5 to 12 odd % this year so far, and you can see that the last bit over there where the gap had in fact widened. But in terms of, I went further to analyze what kind of stocks do they have and what are the sectors that they are exposed to. So if you have a look at the Tata Group, of course, more number of companies for them and more number of sectors as well for them. So 24 and 8 are the sectors that they have. Mahindra Group, 8 stocks, comprising of 5 sectors, and we have the Birla Group also, which is exposed to about 4 sectors. And remember that these are only listed organizations that we have talking about. In terms of the wealth that they have created, of course, the Tata Group, with a total market cap in excess of 12.5 lakh crores, has added nearly 2 lakh crores this year itself. With the Birla Group, that has in fact, has some concern over there because there has been market cap shedding of about 43,000 odd crores. Now, if we look at some of the performance of the companies that we have on each of these indices, the top weight, so what you have in terms of the Tata Group is TCS, which has a market cap of about 8.44 lakh crores. That itself has added more than 3 lakh crores this year itself, with a gain of stock price in excess of 60%. M&M from the Mahindra Group, that has in excess of 1 lakh crores in market cap and has added nearly 20,000 crores with a gain of about 20 odd %. Why the Aditya Birla Group has underperformed is because of its exposure towards the cement space. That has not done well, and Ultratech numbers actually show you that. The other interesting bit, Neeraj, was that both Tata Group and Mahindra Group have exposure, or rather high exposure towards the IT space, which has done really well this year. And on the other hand, the Birla Group does not have any IT exposure, and therefore the underperformance. Now, some of the other things that we also did was look at the companies that have actually outperformed and underperformed for each of these groups. So first, let's start with the Tata Group. Now, we have Nelco, which has given more than double shareholder value for this year itself. And we have TCS and Tata Elxsi, which have also risen nearly 50 to 60 odd %. So these are the top 3 gainers from the Tata house. Moving on, similarly, we have the Mahindra space as well. where you have Tech Mahindra, that is the top gainer from the IT space, gain of about 50% and Mahindra Logistics and M&M also featured in that list. Lastly, we have the Birla Group, and if we can have a look at those constituents as well, it'll show you that this is the group which has been on a downward trajectory. So we have Aditya Birla Money and Aditya Birla Capital, which have eroded shareholder value to about 35 to 60% odd.
Aditya Birla Fashion doesn't feature in this index for the Birla Group?
It does.
So that was one gainer.
Yes, that I think is the only gainer that they have so far this year.
Yeah, very interesting. Jayesh, thanks for putting this into perspective, the tale of the Titans. But irrespective of what the performances are, it's just very interesting that we have an index for some of the large corporates which is there on the National Stock Exchange. Well, that's all that we have on First Word today. A quick programming note, a special conversation on India's resilience to global risks and domestic nervousness with Sanjay Mukim of Bank of America Merrill Lynch is coming up at 9:30 a.m. today. But that's for the long term. For the day's trade, after this break, a full tilt towards the day's trade. Stay tuned.
Good news, got a promotion and a damn good raise.
Congrats बेटा।
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good, but आज की जनरेशन wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना, same choice. LIC.
LIC, trending with times. 62 सालों से हर जनरेशन की पसंद।
When I started juicing to bounce back from a serious injury, I had no idea that it would turn into a passion, that would turn into a brand that provides healthy choices to millions of consumers. Today, my brand is a household name. I am Anuj Rakhian, and my story is a clean and a flavorful one. I'm the raw pressery guy, and I'm here to tell you my story only on Aegon's of Business.
Aegon's of Business never stop. Only on Bloomberg Quint.
Hi, I'm Jatin Khimani. I'll be at Investors Carnival this year talking about the art of selling stocks. Watch me on Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning to all our viewers. You're watching Indian Open right here on Bloomberg Quint. A quick look across Asia and how we're stacked up for trade this morning. We've got the Nikkei 225 trading marginally higher by about 0.2%, while the Shanghai trades lower by about 0.5%. So pretty catatonic for our markets as well in terms of the SGX Nifty trade. Flat as flat can be. 10,989 is where we are currently trading at. For the futures and options space and the cues that we pick up from there before we start off trade this morning, yesterday's session was a complete bleed, but towards the end of trade, you had the Bank Nifty actually surpassing the lows it made on Friday. So that was a little bit of a concern area. But remember, this is expiry week. Thursday is the expiry for the month. So we're going to be all eyes out for what's been happening on the rollover front, and especially in terms of the build-up in the next month series. Agam joins it with more details. Agam, good morning.
Good morning, Devina. Well, we are keeping an eye on rollovers, as you've already suggested, considering rollovers for the Nifty at this point in time stand at nearly 18%. This is largely in line with the previous 3-month average, but we're going to have to wait and watch whether or not this is towards the long side or the short side. It's the same for the Nifty banking indices too, and the Nifty banking futures rollovers stand around 16%. Let's move on and take a look at the other variables then. India Volatility Index rising by 12%. This is the time, given the fact that we've moved above the mark of 17, the India Volatility Index is now at a 7-month high, and a lot of those traders who are longs in the markets must be very cautious. When it comes to changes in open interest, it was essentially the 11,000 and the 11,100 calls which saw more writing. Considering the fact that the Nifty went below that level, we're likely to see, well, some weakness in the opening according to the indications of the SGX Nifty. Can we see more writing in these levels? Let's wait and watch. The positive perhaps is that there was writing coming along in the 10,800 put, and that could serve as a near-term support moving in. But let's take a look at the put-call ratio. That has come off to a very neutral level of around 1.05, which means there's nearly one call for one put in open interest out there. Walkout, of course, moves out of the F&O band. 3 stocks I'm watching out for. The first one is Motherson Sumi. Took a knock of 8%. We're seeing substantial increase, accumulation in open interest towards fresh shots, and that is the same for Bajaj Finance as well, which has come off substantially. Now below the mark of 2,300, watch out for that, fresh shots there. And Muthoot Finance from the financial sector, again showing a substantial amount of weakness, and we're seeing fresh shots there as well. So the question really is, can we expect some respite going into today's day of trade? Can we see some short covering, or will the weakness continue?
Well, thanks for that, Agam. Thanks for putting that into perspective. I don't know, it'll be interesting to see what happens here, right? There might be respite for a day or two if it comes about or no. But this whole conversation about the asset liability mismatch and how the cost for some of these NBFCs might go up, it's difficult to figure out whether...
Especially their short-term liabilities, which they need to pay back in terms of their coupon rates. So it's going to be a pain point.
Yeah, for some of them at least. So, yesterday I was going through a presentation that was forwarded to me by somebody who's done a back of the envelope calculation. Companies like Bajaj Finance, the renewal doesn't come for some time now. The quantum is also fairly less. So while it's been dragged down lower, it may not face the kind of pressure that some of the other NBFCs, Diwan Housing and some of the others might face. So that is one. But two, just this whole sentiment that has been built around why all the haloed stocks and the NBFC space in particular, with the kind of valuations that they were trading at, why is it that there is no merit in these stocks going down another 20-30% even after the falls that we've seen? Saurabh Mukherjee was making this point yesterday as well.
Yeah, and we've seen that in most of the stocks, and even in some of the AMC names. We've had R&M coming down from 240 to about 170. You have an HDFC AMC which has come down to 1330 from an 1800. So I mean, there were takers at that price, and these stocks are a bit isolated right now, which makes you wonder, like, where's all the interest gone all of a sudden? And,
completely. So I mean, and again for for some of them it's case specific. For the AMCs, you can at least argue that there is a regulatory change that has happened, as a result of which there is a business case for these stocks to come off the way they have. But
valuations have significantly improved. So yesterday, in fact, I think Saurabh, when he was making the point, it was Sanjeev Bhasin who said that for HDFC AMC, the market cap to AUM, which was at about 11-12 at the time of listing, has come off significantly to, I think, about 8 or so.
Yeah, and R&M is at 3.5.
Yeah, so I mean, if at that point people made a case of buying at 11-12.
Yeah, I mean, I somehow don't quite agree with that point, only because at 11, it was all blue sky scenario. The TRs were not reduced, the commissions were allowed to be paid, and therefore the closed-ended funds selling would have continued as is. Now, there is a very high probability that when these norms come into effect, distributors will not have the ammo or the incentive to go out and sell closed-ended funds. What if ULIPs take over? And therefore, what if we are staring at a scenario that once these norms come into effect, we see negative flows for some of these AMCs?
But you know, Neeraj, when we were doing the mutual fund show with Vijay Mantri, he said ultimately, while the top line will get affected, it's the fund's performance that is going to attract investment. So no, so a 25 basis point here or there on the cost may not have that bigger bearing on the bottom line at least. Top line, yeah, you may have a shave off there to the tune of about 15%. But the fund's performance is something that you have to clearly watch from an investor's perspective before you even think of diverting money elsewhere.
Yep, well, let's wait and watch. The market verdict is out there clearly for some of these stocks, and they have been beaten down. Let's see if there is more in store for the AMC names as well. Well, speaking of names that will react today, let's get in our research team to talk about the key stocks in news today. Some of them, well, I dare say, might react negatively as well, but it's a full house. And Nikki, Shraddha, both of them have already joined us on First Word, joining again. And Yatin and Saloni to take us through some other stocks. Really interested in Edelweiss presentation as well, because the NBFCs are firmly in focus. But Shraddha, I suspect the stocks in news, so let's start with you first.
Right, you've already discussed this, Neeraj, but I just want to highlight Yes Bank, and they have their board meeting today to decide on the next course of action after RBI capped the current MD and CEO's term. So that will continue to remain on radar today. Apart from that, they've also yesterday highlighted that they're retaining their credit cost guidance for FY19 at 50 to 70 basis points itself, no change in that. And they've also shared some clarification with respect to the domestic money transfer program, where the GST or service tax claims amount to 38 crores, which they have paid, but they believe that the method of computation for the transactions was correct, and they will continue to take this issue forward with the concerned authority, but they've paid the 38 crores. That apart, a lot of deal wins. Infosys has won a deal worth 80 million Canadian dollars, which is about 450 crores. Zilip Bilcon has been declared as the lowest bidder for a EPC project worth 600 crores. Inza Technologies has won a deal from UK-based investment company to manage end-to-end infra requirements. Himachal Futuristic Communications has received a purchase order for 558 crores. And finally, Care Ratings, where Papra Investment Fund has picked up 1.74% stake. So these are some of the stocks which should be in focus.
Should be interesting in a dull market if Monish Babra's name evokes some response on Care Ratings. Thanks a lot for that, Shraddha. Saloni, speaking of NBFCs, we were just talking about them all through, and no surprise there, but Edelweiss had an investor day.
So, first and foremost, they highlighted about the recent concern that we have been seeing in NBFC space. Now, they believe that despite the recent volatility in the NBFC space, they believe that the loan growth across NBFCs will moderate at least over the next year, and hence they look to increase liquidity cushion from 10% of assets to 15% going ahead. Despite the volatility in NBFC space, Edelweiss does not expect any significant asset quality deterioration across the industry. Now, as highlighted earlier by the company, they will continue to focus on wholesale credit business via fee-based funds rather than funding it through their own balance sheet. On the NCLT front, they believe that though the process is taking a little time in the courts, they do not see any inordinate delays in the same. They are in fact seeing values of some assets going up largely due to higher bids coming in for few assets. On real estate front, residential inventory levels have been declining significantly, which is a positive for the company, while commercial real estate business continues to do better. In terms of wealth management business, they expect a negligible impact on profits due to change in total expense ratio for mutual funds, while they see bigger and better opportunities in alternative space where they continue to maintain the leadership position. And lastly, they expect a cost to income ratio to come down to 40% in next 2 to 3 years as compared to 46% that we have seen in FY18, Neeraj.
Well, let's wait and watch. Edelweiss as a stock has corrected quite significantly. Boy, investors needed an investor day for sure. Okay, what are brokerage opinions coming in? I think Macquarie's come out with a note on metals. Nikki, can we start with that first?
Yeah, that's a mixed note actually on the metal space. It says that they expect lower prices for lead, silver and zinc, and higher prices that for alumina and along with aluminium due to the supply situation, also due to the the cancellation of China capacity and the depreciation in rupee also adds to the tailwind. On back of that, however, they're saying they see base metals having more downside risk as compared to the belts. Having said that, they've downgraded Hindustan Zinc and JSW Steel. Zinc has been downgraded to underperform on earnings headwinds along with the premium valuation. JSW Steel has been downgraded on account of the fair valuation currently that the stock is trading at right now. In terms of the top buys that the brokerage has in terms of in this space, Hindalco, Nalco, Coal India, and importantly Graphite India.
Okay, interesting note as well. Thanks a lot, Macquarie. Well, there were large coverage commodity names, so important note on metals. Mixed note, as Nikki said. Is it mixed for Eicher Motors?
Not mixed, but highly bullish. As far as Eicher Motors is concerned, from Goldman. And the timing of the report is quite interesting. Yesterday, the stock was down, 8-9% on an intraday basis, and today Goldman Sachs has come out with a note. They maintain a buy with a target price of close to 37,350, which means a 44% upside on Eicher Motors. Given the fact that all the auto stocks rate sensitives are under pressure. However, if you look at the rationale, Goldman Sachs believes that the two new motorcycles that the company has launched will be gaining significant traction in the domestic market as well as for the export market, and this new launch would be a key catalyst for the stock moving ahead. In fact, Goldman Sachs goes ahead and says that the new launches are a huge leap in terms of the engineering quality and design of products. And the important thing to watch out for will be the launch price, initial feedback, and the export market volume expectations. So, on the back of new product launches, Goldman Sachs is quite bullish on Eicher Motors, sees upside of 44% in such markets.
Interesting. Let's see if that happens. Yatin, thanks for putting that into perspective. Mayuresh Joshi from Angel Broking, I'm told, with us on the show as well. Mayuresh, good morning. Thanks so much for joining in. Rate sensitives getting badgered. Autos were the biggest casualty, or amongst the biggest casualties yesterday, Mayuresh. What's your stance now? I mean, let the storm pass, or is it prudent to selectively choose one or two of these auto companies after the beating that they've received, not just in the last 1 month, but possibly calendar year 18?
Oh, absolutely, Neeraj. And again, I think the mayhem that the markets are currently going through, I think the sentiments are obviously sour on the street. Having said that, again, the performance that these companies have given, if you take a comparative check over the past 2 to 3 months, I think it's been a little bit tepid. And what probably happens in a rising interest rate scenario is that there are apprehensions of purchases being delayed. So to that bit, I think a bit of these apprehensions getting played out on the stocks have already resulted in the kind of growth-degrowth that can probably just hamper the earnings prospects of these stocks. But again, I think the festive season is going to come around. You might see some amount of discounting factor that these auto companies will probably meet out. And then again, that probably has a say in terms of the overall near-term earnings. But over the longer period of time, as things do stabilize and as the natural demand, which probably stays as a latent demand and catches up going forward, I think the volume should come back. So I think the qualitative stocks which have taken a beating might have near-term concerns, and absolute near-term concerns as I say this. But over a longer period of time, obviously, I think qualitative franchisees should hold up. So yes, I think we still maintain a positive view. I think stocks like Maruti, what Yatin mentioned, Eicher Motors, might witness some amount of a margin dip and volume degrowth from a near-term perspective. But the longer-term prospects obviously remain same as they revert back to mean reversion over the next few quarters.
All right, and the Nifty Auto Index in terms of technical indicators has also gone into the oversold region with the RSI rating of 24 after the last 2 days correction that the index as a whole has seen, and so have all the other stocks. So that's the Nifty Auto Index, which was down about 4% in trade yesterday. The other pocket obviously is banks, and Bank Nifty, like we've been highlighting, the close of yesterday was extremely concerning. After the low that it closed, 25,053 was the low on Friday session. It took that down. 24,970 is where it closed. So does it leave us, to tread our way on a bottomless pit? We'll have to wait and watch. But Mayuresh, banks, NBFCs, the financial space as a whole right now, how vulnerable is it?
Morning, Devina. No, absolutely vulnerable. And if you're probably looking at how the trends are panning out at this point of time, I think it's more fear on the street at this point of time on what might go wrong, both in terms of asset quality pressures, what probably happens in terms of credit, what probably happens in terms of their exposure in terms of the various borrowing mechanisms that they have adopted. So whether that is commercial paper and what you've seen in the aftermath of what DSP-MF had done, I think that kind of triggers off a contagion risk, specifically in terms of NBFC stocks. So I think in a rising interest rate scenario, as I mentioned earlier, and there are every expectations in terms of what you're probably seeing, both in terms of bond yields and the general macro situation. If RBI does hike rates, that obviously takes the cost curve higher for all these companies. Whether they're able to pass this through in terms of their lending rates, in terms to support their NIMs and spreads, I think it happens with a lag effect, but I think most of the companies will be successfully able to do that. What kind of an impact does that have in terms of their overall credits and in terms of their overall advances growth, as well as how do they manage to keep a tab in terms of their asset quality, specifically for NBFCs who've got a large exposure towards LAP, developer loans. I think that probably becomes a very, very questionable apprehension at this point of time. Again, I think the asset liability mismatch for a few companies which are probably much higher leverage than the others and which probably have a lower capital adequacy might get hit. So I think the apprehensions are probably valid for a few NBFCs, but to paint the brush probably that the entire space probably might just go through periods of earnings downgrades, I don't think that's a possibility. So yes, I think that this is a period of uncertainty at this point of time, but we do remain optimistic on select NBFCs and banks. However, I think the near-term perspective, because of weak sentiments, obviously is going to play out negatively on the sector as a whole.
Before I go to Amit, just one question. You said there are a few which you still feel are good enough from an investment perspective. I just want to look at some of the asset finance companies, and we just did a piece earlier on how valuations for some of them have started to trade at a discount to its 5-year average. The likes of an L&T Finance, which is trading at a 5% discount to its 5-year average in terms of the price to book multiple. Mahindra Finance, Edelweiss though, is still on the heavier side with its premium. But what are you liking in specific names?
No, so Devina, I think if you look at Bajaj Finance, for example, I think the kind of franchise that this firm has and the kind of expectations of both AUM growth in excess of 20-25 odd percent, yes, I think that can taper off in a scenario where discretionary demand actually goes down. As I said, the delay in probably having some purchases getting elongated over the next 2 to 3 months. But a large element in terms of even if the cost structure goes up, you're probably expected to see NIMs compress a tad bit, but the overall business scenario and the business model still remains extremely robust. Yes, valuations had gone through the roof, but any meaningful correction henceforth, I think because of the contractions that you'll see both in terms of forward Ps and forward price to book ratios, I think that probably becomes a very good entry point because the ROAs still justifying the kind of growth that the stock can exhibit. You just mentioned L&T Finance, for example. I think the rural sector obviously is doing very, very well for them. What you've also probably seen in terms of their fee income growth, even if one assumes that the fee income growth probably comes down because of the drawdown that they probably do in their assets and the securitization aspect as well, you're still expected to see a very reasonable amount of growth. Again, in terms of asset quality, and probably if you look at the stage 3, which they have reported in the quarter gone by, I think you're probably looking at the peak in terms of what they've probably reported and the kind of provisioning that they've done. So from price to book parameter, if that also corrects significantly, I think you're probably going to get good value for money over the longer period of time.
Let's wait and watch this space peppered with names currently which have corrected quite a bit. Maybe some ideas there. Let's get in our technical experts on board. Amit Harchekar, Director at Index Genius Investment Advisors, with us on the show, as is Hadrien Mendonca, Senior Technical Analyst at IIFL. Gentlemen, both of you, good morning. Thanks so much for joining in. Amit, thanks for being patient with us. How are you approaching trade today? We start off with a bit of a lull, but if you were to take fresh positions on either the Nifty or the Nifty Bank, what would those be?
Well, the view for the market still remain cautious because from the open interest front, we are still seeing a lot of unwinding. In fact, the long positions which were created even after a decline, even that are getting unwinded. So there is a possibility that Nifty could be heading further 1 to 2% lower in the near term. Now what we believe is whatever decline what the market is saying, that is trying to pricing weak rupee. We are expecting rupee to test 74.5, and we believe when the rupee would test 74-75 zone, you will see minimum decline in Nifty. So market is already trying to price the weakness in rupee, and then it would stabilize. So if there is a pullback in Nifty towards 11,050, that again becomes a good shorting opportunity. But from a positional perspective, the stop loss for your short trade would be at around 11,250 on the future front. Till the time, I think this market remains sell on every rise. Most importantly, even in yesterday's trade, Nifty mid-cap index has given a breakdown from 1 year of consolidation, and now we are expecting a decline of at least 15 to 18% in Nifty mid-cap index. Now, if you try to see the market picture from an overall perspective, the ratio of Nifty 50 to Nifty 500, that has remained constant in last 5 to 10 trading sessions. So whatever the churning is happening, money is flowing out from the broader indices and coming back to Nifty. So overall view from a 6 months perspective for the Nifty is quite positive, but in the short term there will be some pain, and mid caps we are expecting lower levels of at least 20 to 50 or 30% in the coming 3 to 4 months perspective.
Okay. Before we come on to your stock calls, I'm going to quickly go across to Hadrien to take a quick call on the index, on the Nifty or the Bank Nifty. Hadrien.
Yeah, hi, good morning. So Nifty continues to remain weak, and I think there is still more scope for a little bit of downside going forward. Remember, we have still not hit the oversold zone, so there is still more scope in going lower from here on as well. So the trade definitely has to be holding on to your short positions. Nifty has actually formed a bearish belt hold kind of a candlestick pattern. It has slipped below its important 50 as well as the 100-day moving average. It has also seen short-term negative crossovers on the short-term averages, which is not a good sign. So I think a little more of lower side is still yet to happen, and short position should be held on to. However, looking at the long-term charts, it's very interesting that we are approaching very important support areas. So first and foremost, the 10,750 zone is something very important, because the long-term rising trend channel support is at the 11,750 zone, around the 10,750 zone. As far as the long-term 200-day moving average is concerned, it is also close to the 10,770 zone. So 10,750 and 10,770, if we see a breach below those levels, I think it could be a little more difficult to for markets to stage a very good pullback. But I think if you look at the 2 years history, how Nifty has behaved around the 200-day moving average, we have definitely seen a breach of these levels, and this is what is called a deceived trade. Markets actually deceive after breaking the 200-day moving average, and that's when the next phase of a strong bull run begins. Similar things happened in March 2018, similar things happened in November 2016 before that great upswing started. So I think this is something that I'm really expecting a breach of the 200-day moving average, only after which we could see a little bit of stabilizing and, again, a resumption of the northbound journey could begin. Till then, cautious, trades should be intact.
Okay. And maybe once this breach happens and there's some consolidation, we'll talk about whether there is possibility of an upside or whether there is some more downside. So interesting moment levels. But essentially, both are experts cautious on the markets right now, no long positions being taken. Before we get to stock-specific ideas, it's time for Bloomberg Edge, wherein Jayesh Kinani tells us about a pattern that the terminal has thrown up on a stock. Jayesh, what's the stock on our radar today?
Morning, Neeraj. It's KPIT Technologies, and there is an early buy setup on the stochastic indicator. Also, I was looking at the analyst comments, and the target price is about 13.5% above where the current market price is. But first, let's have a look at the stochastic indicator and the theory behind it. Well, it helps you to identify when a price move is actually overextended by measuring where the current price is in context to the recent high or the recent low that the stock would have clocked for itself. Few conditions that you have to keep in mind while using the stochastic: overbought is above 80 and oversold is below 20. And a crossover between the two lines which get plotted on the stochastic indicator give you your buy and sell signal depending on the direction of the crossover. With that, let's have a look at the chart of KPIT Technologies, and you can see that the price has in fact declined swiftly from in excess of 300 levels to currently at about 275 odd levels, and the bottom indicator shows you the stochastic indicator. Now, why I said that this is a early buy setup is when you zoom into this, you'll see that though the blue line has crossed above the white line, but both of them are actually just shy of the green line, which is the oversold line. Once these actually cross above, that is where you will get your confirmation of buy signal.
And how accurate is this?
They've been a last 1 year, 10 out of the last 11 such trades have been profitable with net profit of about 45%.
Got that. Jayesh, thanks very much for that. So watch out for KPIT Tech. That's the stock that Jayesh has picked out. One more other name is Reliance Industries. From trading near those levels of 1300, the stock is now down to about 1232, but still not as bad as what some of the others on the index have done. From a stock perspective right now, is there any buy indicator on a Reliance Industry, Hadrien?
Yes, absolutely. If you look at the smaller time frame chart, it has already broken out in yesterday's trade. In fact, it was one of the stocks that was defying the selling pressure that we are seeing, across the board. So Reliance Industries definitely seems to be one of the stronger picks. In fact, if you look at the daily chart, it is in the midst of forming a flag pattern, and flag patterns should not be missed once we see a breakout in them. So in Reliance Industries, if you see the daily chart, a flag pattern breakout is seen only above 1240 levels. So on about 1240, one should definitely buy Reliance Industries, and I'm expecting again Reliance to move beyond the 1300 levels. If this breakout unfolds the way it should. So definitely a buy in Reliance at this point.
Okay. Let's talk about specific ideas. Amit, Harchekar, your stock recommendations for the day. You have a sell on a BOB and a buy on NTPC. Let's talk about those two first.
Well, the first would be buying NTPC at around 170, and the stop loss would be 165, and we are expecting the stock to move to 180. Now, reasoning behind is, if you see the Nifty Public Sector Enterprise Index, where ONGC and NTPC becomes a very good heavyweight into them, they are showing good amount of strength despite such a high volatility in the markets. So we are expecting that Nifty Public Sector Enterprise Index to go up by 7 to 8%, or at least outperform the Nifty in the coming days. So that's why we are expecting both these stocks to outperform in the coming days. Second would be going short on Bank of Baroda below 108 on the future side, and we are expecting it to go to 95 to 98 zone. Now stop loss for your short trade would be at 113. In yesterday's trade, we have seen a massive breakdown in Nifty Public PSU Bank Index, and now the index could easily drop by 17% in next coming weeks. So every pullback should be used in this PSU Bank Index to create fresh short positions. For Bank of Baroda, the major support was placed at around 113, and that's why we are suggesting a stop loss of 113 on a closing basis. And last trade would be going short on Tata Motors. Now, despite stock entering into a highly oversold zone, we have seen a breakdown in Nifty Auto Index, and that has opened a further downside scope of at least 7 to 8% in the near term. Now in Tata Motors, the major long positions were created at around 245. Now they are getting unwinded. So we would suggest keeping a stop loss of 250 on the future front. And in the short term, we are expecting Tata Motors to slide towards 225.
Adrian, your idea is a buy and a sell call from your side too.
Yeah, absolutely. And technology is a space that is the only index that is showing some kind of positive moves. And I'm going with an HCL Tech with a long position in the stock. We are seeing the stock is trying to break out from a range that it has been set into in the past 1.5 to 2 weeks. I think it is on the verge of a breakout, and it merits a buy at these levels. HCL Tech should be bought for a target of 1126, placing a stop loss at 1081. The second stock that we are bearish on in the short term is PVR. We are expecting the stock to further decline from here, mainly because we have witnessed a bearish engulfing pattern formation on the daily charts, accompanied with a break of the long-term 200-day moving average that we saw yesterday. So I think weakness is here to persist in PVR. One can short sell PVR September futures for a target of 1249 and keep a stop loss at 1301 in the short term.
Mayuresh, what are you doing with commodities? Let's talk about the upstream oil and gas names, which did particularly well yesterday. And metals is a pocket. I mean, we've been seeing base metal prices moving up over the last few days on the international markets, which have taken a break in today's session. But nonetheless, what do you do with ferrous, non-ferrous, and the upstream oil and gas companies?
So, Devini, for upstream in general, I think with the price of Brent moving up higher and with the current mechanism in place, I think it's a straight pass-through in terms of the gross realizations per barrel that these companies report, and directly, I think, percolates into the bottom line. The second element for these upstream companies also becomes that rupee is depreciated, which basically means that the translationary nature in terms of P&L actually abets their earnings. The third angle that probably comes through again is because of the elevated cost that we've seen. You've also got elevated expenditure in terms of the exploratory assets that they have got. But the fourth element, which can also act as an overhang on the stock, is that if Brent still keeps on moving higher, and the kind of numbers that we are hearing from international experts, you probably got a situation where the government might actually start imposing some amount of a subsidy burden. So that probably might cap the earnings perspective. The yields are fantastic for PSU upstream players, so that's ONGC, Oil India. So to that bit, I think there does exist a potential upside.
Right, Mayuresh, I request you to hold that thought. I'll come back to you post pre-open. But we've got about 8 seconds left to go for market pre-open. Asia, not too many cues coming out from there. For SGX Nifty, we're absolutely flat in trade, and the pre-open ticks up on your screen. So you've got the Nifty 50 trading higher by 0.25% at 10,996. Sensex trading at 36,450. Let's take a quick look at individual movers on the index and what's been making its move. So Yes Bank stacks up at the top, 10% move on Yes Bank. We had some positive comments coming out from the management, probably soothing some nerves there, but this is too early, so we'll wait and watch and see how the prices take shape. HDFC is up 10%. You've got a Bharti Airtel, which is up 9.5%, ONGC, which is up about 3% NTPC is up 2.7%, Tata Steel, that makes a move on the upside too, 1.2%, HCL Technologies up 1%, Bajaj Finance is up 0.75%. Amongst the losers, the BPCL is down about 2%. Wipro down 1.5% from the oil marketing pack. The other one, that's IOC, is also down in trade. Z is down 0.5%. ICICI Bank is down. Ultratech Cement and Bajaj Auto are some of the other losers in trade. Maruti is also down. Eicher Motors again, but flattish sort of a move. So the auto index itself, which was beaten down yesterday, seems to be under a little bit of pressure as we open up for trade this morning as well.
8K miles and all those knowledge to the investors coming out yesterday is likely having some impact on that stock. Unchanged right now. It was down about 5%. Actually, these stocks are moving all over the place. Jet Airways, for example, has this big, large downtick, primarily on account of maybe what crude oil is doing. I don't quite know if it'll stay down 8%. Really doubt it, to be honest, but let's wait and watch. You never know what happens these days. By the way, the currency started off as well on a weak, very weak, 72.91 now for the rupee, and that is putting, there is further pressure on the currency, primarily on account of what crude oil is doing. Brent northwards of $80 a barrel, and that will have an impact on our macros and therefore the currency as well. The bond yields too should have inched up higher, by the way, 8.13. So, well, 2 days of hardening and now a flattish start, but let's wait and watch what happens there. What else? So 8K miles is down 5%, yes, in the pre-open session. M&M Financial and some of the other NBFCs. IDFC Bank, by the way, is down about 3.5% too, so there's weakness thereof. On the flip side, don't look at Infibeam, very difficult stock to trade. Indiabulls Housing Finance, after 2 days of carnage, seems to have stabilized a bit. Let's wait and watch if that lasts or no. HFCL has got this order, 500 or 600 odd crores, and that stock is up about 4 or 5% in trade. And Central Bank, after 2 days of getting clobbered out of shape, seems to be marginally in the green, but these are too early rates. Let's wait and watch if these rates stabilize or no. Just Oil India, one stock that I want to point out, non-index, but along with ONGC was performing very well. Let's see if Oil India starts off well. Yes, maybe about 1% or higher in trade. So not bad space. And steel companies, Tata Steel, etc., is doing well. Lots of queries around steel companies on our live feed as well. So best to get in that follow-up question to Mayuresh before we get in the primary market activity. Mayuresh, the metal names, the Jindal Steels, Tata Steels of the world, what do you do here? Would you go out and buy them? Because the market is looking buoyant.
It seems so, Neeraj, and if you're probably looking at the kind of measures that the government is expected to take in the aftermath of what might happen with the US-China trade wars, you're expected to see some amount of duty hikes to probably safeguard the domestic steel industry in particular. Having said that, I think the demand has remained extremely buoyant, specifically from end-user industries, and what you've probably seen in terms of HRC prices moving up, the prices of both flats and longs, as end products actually moving up as well, is a testimony that demand still probably remains strong. And with the kind of capacities that these companies are operating at this point of time, even if one assumes that the input cost probably goes higher, you've still got that element of strong demand actually ensuring that these companies actually hike prices because of both reasons. And again, because of the rupee depreciation, I think the translationary nature in terms of LME realizations actually abets their growth. So again, the kind of expansions that domestic companies are looking at, what you're probably looking at even in terms of the consolidation of the industry in general, with a few of the good quality stress assets being taken over, though it increases the leverage, particularly in the case of Tata Steel, which also is probably divergent and dependent upon the overseas operations. I think the domestic players like JSW Steel, in my opinion, will continue to do well, both in terms of reported operating parameters as well as volumes holding up for them.
All right, before I go to Shraddha to talk about the new IPO, Yes Bank is cooled off now and it's up about 6% odd. I want to get a quick chart check on whether or not there is a trading opportunity in this one at a level of 236. What does one do in this stock, Amit?
I would say still it's a short sell. Now stop loss for your short trade would be at around 238, and in the short term we are expecting stock to breach 200 quite easily.
Let's wait and watch. Still early days, 3 minutes to go, and let's see if Yes Bank does find a semblance of sanity. Remember, it's not in the same bracket as some of the other NBFCs in terms of the ALM mismatch and what happens to the cost of funds. But maybe there are bigger problems at hand for Yes Bank. Let's wait and watch. Cooling off a little bit from those highs. Amit Harchekar believes that it's still, the trajectory is still on the downside. Okay, before we move any further, news from the primary markets. The IPO of affordable housing player Aavas Financiers opens for subscription today. Company plans to raise a total of 1,734 crores from the issue. Shraddha Babala is here to tell us about all that you need to know about the IPO. Shraddha, good morning yet again.
Good morning, Neeraj. So, yes, the price band for the IPO has been fixed at 818 to 821 per share. The issue size is 1734 crores, out of which 400 crores is fresh issue and 1334 crores is offer for sale by selling shareholders. The implied market cap at the upper price band is 6450 crores, which may make this company larger in terms of market cap than even a Canfin Homes or a Repco Home for that matter. This is what the post-issue shareholding pattern will look like. The promoter and promoter group held over 80% stake, this is largely the picture of selling shareholders. AU Small Finance Bank also held about 6.8% stake on a pre-IPO basis, but they are not selling in this issue, and in fact they are one of the largest anchor investors to the issue. So with this, the IPO will be able to provide a partial exit to promoters and also help augment the capital base of the company. So those are the issue details. What is the company's business? What do they exactly do? It's a retail affordable housing financier which started operations in March 2012. Earlier it was a subsidiary of AU Small Finance Bank, but is now promoted by private equity players like Kedara. They lend mainly to low-ticket, high-yield segments. They're targeting low-income and semi-rural and semi-urban customers, and largely self-employed and not the salaried segment. They have a network of 165 branches over 8 states. But if you look at the geographic split of the loan book, you will see that just 4 states, that is Rajasthan, Gujarat, Maharashtra and Madhya Pradesh, contributed to over 92% of the loan book, and just one state, which is Rajasthan, contributed over 46% of the loan book in FY18. And given the past experience, we have seen that in case of a state-specific issue or slowdown, regional housing finance companies also see a slowdown in their growth and profitability. So high concentration risk, that's as far as the business is concerned.
And what about the financials, Shraddha? And now, post understanding this, what are brokerages saying?
Right. So over the past 5 years, in each of the years, the company has been able to deliver a net profit in excess of 60%. So if you look at the FY 14 to 18 period, the loan book has grown at a CAGR of nearly 59% and net profit at 71%. Even if you look at the other operating parameters, they are absolutely healthy, with the gross NPA ratio at just 0.34%. It enjoys net interest margins in excess of 7%, but the capital adequacy ratio is extremely high at 61%. And this is one of the reasons for the suboptimal ROE that the company has at 11.2% in FY19. So that's as far as the financials are concerned. How does it stack up in comparison to peers? Well, on a post-money basis at the upper price band, the asking price to book value multiple is 4.1, which is higher than some of the peers, especially in the backdrop of its relatively lower return ratio profile. Overall, brokerages have a subscribe recommendation on this IPO given the long-term prospects of the company. Prabhudas Leela, there is only one which has an avoid because they believe that the pricey valuations leave some scope for a negative surprise, but overall a subscribe rating in at large for this one. Devina.
All right, Shraddha, thanks very much for that. So overall subscribe rating barring one, Prabhudas Leela, which finds the valuations a bit too steep at this current point. Quickly looking at the index now, absolutely flat in pre-market trade. Anything else, at least on the chart, Hadrien, that we can look at, from an intraday perspective, probably towards the end of trade, we can see some movement, and therefore you would want to take either a buy or a sell call on it?
Yeah, so Equitas is one stock that is looking pretty weak. In fact, in the past 2 days, we have seen aggressive short selling happening in the stock. So I think Equitas still has the the legs to move lower from here on. I think one can go ahead and short Equitas at these levels, and I'm expecting a target of close to 125 to 124 on downside. As far as the stop loss is concerned, we should keep a strict stop loss close to 133 on the upside.
Amit, a query that is repeatedly on the charts, and that's why I'm asking you, do you track a company called BF Investment?
No, I don't track it.
Okay. Hadrien, any chance you track it?
I don't track it, on a daily basis, but I've just gone through the chart, and we have seen some heavy selling happening in the past 4 days. In fact, if you look at the long-term charts, it was on the verge of a breakout on the weekly charts. We had seen a rounding bottom formation, which was a very positive development that we've seen, but still the breakout has not happened. So just to put things into perspective, a breakout will come only above the levels of 350. Once we see that breakout happening, then we could expect some kind of strong up move from there on. But till then, things could be a little difficult for BF Investments.
Appreciate that, Hadrien. Okay, minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. Yes Bank will be in focus after the board is set to meet today to decide the course of action post RBI curtailing Rana Kapoor's term.
SBI Life Insurance says BNP Paribas Cardiff may cut stake in the company to comply with minimum shareholding norms.
A sale raises steel prices for the second time in September, as per a Mint report.
In bulk deals, Pabra Investment Fund acquired 1.7% stake in Care Ratings.
Affordable housing lender Abbas Financiers IPO opens today. Issue price being set at 818 to 821 rupees a share.
And in brokerage calls, Macquarie downgrades Hindustan Zinc to underperform and JSW Steel to neutral.
Very interesting. Okay. By the way, the OMCs look like starting off week as well. Mayuresh, just a quick thought. If you have BP, HP, IOC in your portfolios, would you believe a safer strategy is to get out of them even though the correction has happened, because crude is on the boil right now?
Oh yes, again, and with crude moving higher, it does dent the earnings sensitivity of downstream companies, because the two key variables obviously remain how the direction of Brent moves and what is the rupee direction against the dollar as well. And both of them are not working in favor of the OMC companies at this point of time. Couple that up with the kind of capital expenditure that these companies have laid out, I think the result still is going to be back-ended in terms of their complex capacities and complexities coming up over the next 1.5 to 2 years. But a large element in terms of the sensitivity of earnings hit because of these two variables might still play out on their balance sheets. Again, I think the kind of inventory gains that these companies had reported in the quarter gone by, I think one really needs to probably just exclude the gains stroke losses portion from the inventory side. But a large element in terms of the core earnings remaining weak, at least if these two variables remain where they are, might be on the anvil. So valuations probably have become very, very attractive. The complexity of few of the refining indices is actually looking at probably looking at good times going forward in terms of at least the GRMs holding up, though I think you've seen near-term concerns. So value definitely exists, but when you probably enter, I think maybe over the next few weeks or months, when you're probably seeing much more stability happening on these two key variables. But remaining, I think I remain very, very selective here. So IOC still remains one of my preferred holds at this point of time, where my belief is that the earnings should play out over the next 2 to 3 years.
All right, Mayuresh, Joshi, we'll leave it at that. Thanks very much for joining us. Really appreciate you taking out the time and speaking with us this morning. We've got about 50 seconds or left to go for market opening. So I'm going to quickly get some top calls from our technical analyst. Hadrien, you already mentioned Equitas. Is there anything else that you'd like to cover?
Yeah, I'll go with Reliance. It's a bit safer at the current moment to go with Reliance. I'm expecting a target of 1282, keeping a stop loss at 1210. But just a caveat here, one should buy Reliance only above 1240 levels.
Okay, 1240. It's at 1235. So probably post opening we'll see. Amit, what about you?
I would go short on DCB Bank futures. Here we are expecting target of 145, stop loss will be 160, and secondly buying ONGC on a decline with a stop of 172. We are expecting it to go towards 185.
Okay, gentlemen, thank you so much for joining us today. Here's the market at open, flattish start for all the key indices thus far. So the pre-open rates too in the early half were a bit deceptive. The mid caps and the small caps should come out soon. By the way, the Nifty Bank has quickly slipped about 1/3 of 0.5% into the red, and the mid caps and the small caps start off weak too. I just want to bring up the Nifty Bank once, the intraday or whatever the block if we can of the Nifty Bank, because that index has quickly slipped into the red, about 2/3 in the red now. For the Nifty Bank. So weak start for the banks for sure, and that might play on the markets. Bring up the heat map and try and show you what's moving and what's not. Well, Indiabulls Housing Finance, yet another day of fall. It was 8% Friday, 8% Monday, and about 3% right now. Bajaj Finance, no matter how high quality the name may be, the stock is down another 2% in trade. You expected BP, HPIC to be in the red because of the crude movement, and they are in the red. ICICI Bank is amongst the stocks which is also trading with a fair bit of red on the screen. On open, about 1%, 1.5%. So not that great. As we speak, of course, the index is bobbing between the red and the green. So no big concerns on the benchmarks. Just the Nifty Bank is looking weak, predominantly dragged by some heavyweight banks like ICICI and some NBFCs having some pressure, so that sentiment around them not that great. What's providing support? Yes Bank, a couple of percentage points higher. HDFC was down about 6% yesterday, a couple of percentage points higher. Naturally, ONGC and the likes of Oil India might be in the green, and ONGC's in the green, but yeah, a bit of a defensive bent. Coal India for the last 2 days has been doing well. Sun Pharma has not done all that poorly. There is some strength in Ultratech Cement in the session today. IT and Reliance too marginally in the green, but a fair bit of red, and banks under pressure. Indiabulls Housing Finance now down 3.5%, Bajaj Finance 2.5%. NBFC is not seeing the light at the end of the day. Devina, what are you spotting?
Well, the mid-cap end also looks a little bit more, the weakness is more pronounced there as compared to the benchmark indices. So the mid-cap index itself is down about more than 0.5%. In terms of specific stocks, I'll start off with a few gainers there. Zensar Technologies is up about 4% in trade. Central Bank sees some sense of semblance after 2 straight days of heavy cuts. So that stock's up about 3%. Infibeam is up 3%. Dena Bank is up 2.7%. You've got Praj Industries at 106. Jindal Stainless is at 61, so that sees an uptick of about 1.8%. Dilip Bilcon, that stock's up about 1.2%. Hathway Cable, that's 1% higher. You've got some interest building up in some of the sugar names as well. So Balrampur Chini, that's up closer to 1%. Bajaj Hindustan, these were stocks which were heavily sold over the last two or three trading sessions, and now a slight pickup is what you're seeing in some of these names. a quick look at the losers, you have a Bombay Dyeing, which is down 5%, in Reliance Com, which is down 4%, Manpasand Beverages is down 3.5%, Karnataka Bank, VIP Industries, both down 3.5% apiece. Diwan Housing again looks under in today's session. Yesterday's session saw it pick up by about 8% or so. Today back down in trade. Berger Paints is down 3.5% as well. But the market breadth is extremely weak at open. You still have a lot more declines than advances. About 826 stocks in the decline versus just about 381 stocks that are advancing.
Yep, weakness percolating. Markets and dotting the bank space for sure. Let's get in the market voice. Chakri Lokapriya, Managing Director at TCG Asset Management, joins us right now on the show. Chakri, good having you. Thanks so much for joining in. Must say it's better having you in the studios, but we'll make do with this appearance today as well. How are you approaching the investing climate currently, Chakri? If you have money coming in from your investors, are you getting tempted to deploy it at these valuations in select pockets, or are you still biding your time because of the uncertainty, not just on the local front, but on the global front, rearing its head again with crude doing what it is doing?
Good morning. Thanks for having me, and sorry that I couldn't be in your studios today. But nevertheless, today, the way we're approaching the markets is, we are staying by the sidelines because we expect that, the tightness in the NBFCs and the tightness in the credit system. Yes, RBI has come out with a 100 billion OMO, announced a 100 billion OMO. That will release some amount of liquidity into the system. But we think another round of OMO is necessary for the liquidity to credit to flow back into the system, or rather the cost of credit to come down a little bit. Mind you, we are heading into the end of this year, which has elections, which has festive seasons, usually periods associated with high credit demand. So on top of that, you have a tightness, so that would lead to a even higher cost of credit. So against this backdrop, we are, keeping some powder dry to wait for the market to settle.
What do you see as the biggest drawback of crude oil reaching $80 per barrel, the Brent crude?
I think one of the biggest things is clearly our the deficits of India will continue to widen, and that is likely to continue to put pressure on the rupee, which has a circular story which leads to inflation, and that might lead RBI to again raise interest rates for all the wrong reasons. So, and which would again slow down growth. So, to get off this kind of a circular reasoning will take time for the market to reset itself.
Currency looks like it's once again approaching those lows. The opening was pretty weak, around 72.91. Its all-time low, I think, is about 72.97. A breach of 73, what kind of a negative sentiment does this throw out in terms of foreign investors as well as jitters within the domestic market?
In terms of foreign investors, this is a redux of what has happened in 2013 when the currency slid about 15%. And year to date, 2018, the currency is again slid about close to 13-14%. So an FII investor hasn't seen gains because of the currency losses. And so against this backdrop, investors with FII investors, I think, will stay by the sidelines until some stability in the rupee's fall emerges. And so I think you will see some kind of slowdown in FII flows until the currency settles down.
Interesting. Chakri, some of these usual suspects and the way they've come off, now some with reason, in fact, well, you argue all with reason because all of them had a very high multiple, whether price to book or price to earning. In the case of the HULs of the world, the P multiples were high. In the case of all the NBFCs, the price to book levels were high. Asset management companies too, the AUM to market cap very high. Is there some cushion that a buyer has, or should people not be brave hearts right now because we don't know the extent of the pressures that might come in, be it on the cost of funding, be it because of external factors like crude and the economic factors deteriorating and therefore prompting RBI to do more? What would you be doing here?
There are two types of sectors, clearly, I mean, if you can try to categorize them like that way, which is in one of the export-related sectors, which will all do fine. IT will continue to do well. Pharmaceutical companies, sectors, pharmaceutical will do well. Metals will continue to do well. And in general, all those chemical companies, etc., which are more export-related, will continue to do well as long as they have low levels of debt. And fortunately, if you look at each one of these sectors, they hardly have any debt on their books. And so cost of funding does not impact them. And the demand, on the other hand, the export demand continues to remain strong. So I would, the way we are approaching is to focus on those sectors and stay away slightly from the domestic sectors. At the same time, the staples, again, you take the Hindustan Levers of the world, it does not have any debt. It's a cash-rich company, a super high ROE company. So that will provide a backstop to its valuations.
What are you doing with financials, Chakri?
Financials, well, now it's become a tale of three parts. One is you have the PSUs, loan growth has come off because of lack of capital. Now, second is, because of the mergers, the recently announced BOB merger, and the expectations that another round of mergers may happen, that will provide a lid on the good performing banks, because now you're making the good banks acquire the weaker banks, so people will stay away from buying the good banks in the PSU space. Second, NBFCs, wherever you have an asset liability mismatch, those banks have corrected quite significantly, so I don't think there's much of a fall left in NBFCs. Then the private banks. In the private banks, you have, on one hand, the valuations are not that demanding if you look at an ICICI or an Axis, and maybe an HDFC bank has also corrected in the last few days. So I think that's where you will continue to see some flows.
Chakri, what about a yes bank? Not really a buy or a sell call here, but do you think the market would shy away from yes bank until the release of the first quarter numbers of the next calendar? Because if indeed we go down the path of Rana Kapoor moving out and a new MD coming in, you don't quite know what the new MD and CEO will want to do with the way the disclosures at Yes Bank have been and the kind of disclosures that come out in the April to June quarter. A lot of people are likening this to what happened to some of the PSUs, wherein the new management comes in and writes off a bunch of skeletons that the old management has left behind. Do you subscribe to this theory, or is the pullback in valuations for Yes Bank enticing enough for somebody to go out and put in money?
No, Yes Bank at the end of the day is today an institution, a well-established franchise, and will do well under whoever is the new MD. But meanwhile, it's rather unfortunate that RBI acted the way it did in giving a very short time frame to find a replacement. So meanwhile, until the new MD is appointed, one of the biggest drivers of Yes Bank's valuation has been its strong loan growth rate of 20-25% plus. Now that is likely to come down. So what will be the new loan growth rate over the next couple of years is going to be the question, and therefore that will determine the valuation. So what worked in the last 10 years for Yes Bank is unlikely to work in the future. And the valuations, yes, are reasonable, but I think the stock is pretty much going to tread water until the new MD or clarity on the new MD is there in the market.
Just look at what's happening, by the way, on the markets. 10 minutes into market open, Diwan Housing is down about 4.5%. Indiabulls Housing corrects another 4.5%. Grove Finance, by the way, has come off quite rapidly, 307 now. So NBFC is still bearing the brunt of selling pressure. The only pocket that seems to be doing reasonably okay is IT, because Zensa Tech, Sonata and some of the others are moving up in trade today. Chakri, my final question, a quick thought here on mid-cap IT. Is there a pocket that you would bet on?
Mid-cap IT, absolutely yes. I think the valuations are fine. More importantly, the demand is even stronger. And against a backdrop of weakness in other sections of the market, mid-cap IT will do well.
What about the larger names? I mean, yesterday you had the likes of TCS, Infi, all of them have gains closer to about 2.5 to 3.5% apiece. TCS, in fact, at its life high now.
Indeed, and you will see some amount of currency benefit which will trickle down to their bottom line. So, and therefore, I think so. Therefore, the sector will continue to do well, and also given that you'll have a higher allocation by funds into the IT sector.
Okay, Chakri, we'll leave it on that note. Thank you so much for taking the time out and being with us today. Really appreciate your time and your thoughts on the platform.
Thank you so much for having me.
Well, by the way, the Nifty Bank is now down 200 points, so close to 1%, and now I would reckon around the 200-day moving average or slightly below that, and that's dragging the benchmark indices along with it.
This raises a lot of alarm bells.
Yep, it does, and let's see what happens to now unwinding, because the Nifty at 10,924, if it stays below or cracks further, then we could see some unwinding of the put positions at the 11,000 strike as well. This doesn't seem to be that great a start.
And the other part being, while the puts start to unwind at 11,000, below 11,000,
it's 10,800.
Is the straight away 10,800 where the support lies.
Well, let's see what happens this expiry. But, well, take a break, but stick to the markets, because coming up on the other side, a conversation with Sanjay Mukim of Bank of America Merrill Lynch on his thoughts on the near term as well as the long term.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, रेज. अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, but policy समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर जनरेशन की पसंद.
When I started juicing to bounce back from a serious injury, I had no idea that it would turn into a passion, that would turn into a brand that provides healthy choices to millions of consumers. Today, my brand is a household name. I am Anuj Rakhian, and my story is a clean and a flavorful one. I'm the raw pressery guy, and I'm here to tell you my story only on Aegon's of Business.
Aegon's of Business never stop. Only on Bloomberg Quint.
I want to talk about how disruptions are coming and how we'll have to weave that into our portfolio, into our investment thesis, because clearly in this whole world of disruption, there will be few winners, but those winners will make tremendous amount of wealth.
Hello and welcome. You're watching Bloomberg Quint. Today I have a very special guest with me at a time that the market cracks are taking center stage. Joining me today in this very special conversation, I have Sanjay Mukim, India equity strategist at Bank of America Merrill Lynch.
Good to be here, Devina.
Thanks very much for joining. And I'm going to start off with what's happening here and now. Up until now, we've been tracking what's been happening globally. You had a pullback of QE, you had trade wars, you had crude oil prices, the EM turmoil, which India seemed to be resilient to up until now, but looks like our armor is starting to get a few chinks and we are starting to look a little unstable.
Right. So first, I will qualify. There was no had. We still have those issues in terms of the external stresses, and our concern as a house is that some of those are here to stay for a while. The Fed tapering, the QT is likely to persist for some time, especially if data and performance of the U.S. economy remains robust. So the question is then, why was the India market as resilient as it was? A couple of guesses really. Who knows the real answer? But one is that India was not perceived to be at too much risk from the trade wars. So if the Chinese market were coming off because of the trade war, India is an island in that respect. And the second was this whole argument of domestic liquidity and domestic support to markets. We did a note recently where I highlighted that it is not the domestic institutions, but it's the domestic non-institutions which had increased their trading share of volumes. If you look at the percentage of volumes that were delivered on a daily basis, that was crashing. The Nifty bid-ask spread was riding. So they were all classic signs of a liquidity event while the market was very, very high. And we highlighted that in our notes. And for one thing or the other, this was not sustainable. Maybe this credit market issue is the tipping point, maybe it's not, we'll figure out. But our argument is that getting into elections, a domestic risk-off is very likely in India. Okay, which is why we have been cautious on the Indian equity markets for a while. And whether this or something else breaks the camel's back, we'll figure out. But I do think that there is further more downside to Indian equities.
Did the pace of this downfall surprise you? And the quickness of it and how fast it came? Because up until just a few days back, we were pretty comfortable on the Indian markets. In terms of valuations as well, we were at the upper end. So right now, the timing of it and the pace of this?
Well, look, it went up as rapidly as well. And as a result of that, India was trading at an all-time high premium to emerging markets on multiples. Now, you could argue that was because the emerging markets has crashed and India had not and so on, but it is a relative investing world. And therefore, I am not surprised that it is coming off as well as, because it wouldn't have slipped. I mean, if markets were as prescient and as patient, then very few of us would have jobs. These shocks are unfortunately very, very frequent. So, the famous argument of black swans being not as rare as you would imagine, that's what's playing out.
Right. And in the same light, when you spoke about domestic investors, the foreign investors stayed on the sideline. They probably missed out on that move that we did see from January onwards. But now with valuations also, correcting a bit, do you see the flows coming our way, or it's still an emerging market allocation which India is a part of, so it may still get a slight sliver of it, but not much?
So there's two parts to it. One is the flows that happen on a passive basis, which is 100% linked to what happens to emerging markets and EM ETFs. So if there is an outflow from EM ETFs and passive money leaving EM, then India will have that same proportionate impact here. The second is then the active fund manager. Now, the trouble with the active managers in looking at India is that valuations are still not at a zone where I would think you would press the button on India. You still, even after this recent correction we've seen, most stocks are still extremely richly priced. And the ancillary point I'd make here is that when the market starts falling, the ability and conviction of people to buy actually reduces, which is why we have cycles. So my sense is that this is not sufficient enough to attract flows. Currency, the external crisis is another concern around that.
You think the RBI and the government are doing enough for the currency?
Well,
or you feel this is a fair value for the currency?
Well, you could pitch it both ways. One is that the rupee needs to keep up with its other EM trading partners. So if the dollar is strengthening and other EM currencies are weakening as well, it is fair to let the rupee also depreciate alongside, because otherwise, imports from China would pick up, which would be another issue going forward. The question then is, what can governments or central banks do? If their stance is to manage the volatility of the move rather than to defend the level of the currency, I think that is fair. Okay, because volatility can hurt businesses, really it can hurt investment sentiment. Also, is $400 billion enough of an ammunition to defend the rupee? Perhaps not. Okay, because
everyone so far is saying that they're comfortable on that.
Yeah.
The reserves are comfortable. So
well, it looks like a big number, $400 billion. But in terms of the number of months of imports, in terms of cover of the short-term debt we have, it's not particularly high. It's probably still where it was in 2013 or 14. Okay, so maybe we have another $30-40 billion worth of selling power with the central bank. But that's about it. So I don't think we are in a situation to start to aggressively defend the rupee just out of an ego issue.
But the RBI hasn't any which ways doing all that much. They've sort of left the rupee to find its own natural course. The government, though, did come out with that 5-point plan, which really didn't do much. The anticipation of the meeting did more for the rupee than the actual outcome of that meeting.
Correct.
So, I mean, do you think on the RBI's part, it is better that they actually don't land up going ahead and selling those precious dollars to help this fall, which in the end may not even happen?
Correct. So look, I think the RBI is being rightfully careful in using the reserves, and they did the right thing first of all in building up the reserves when we were getting flows to begin with. Can the government change the current account situation overnight? The answer is no. Okay, even if you impose all these import duties that are being talked about, will it dramatically alter our external position? Unlikely. Now, a couple of things, right, oil and electronics, we will remain reliant on imports for a while. And frankly, if the position is that the external balance fixing is a policy problem from a government angle rather than a central bank angle, I think that's a fair position to take.
The other side to this is the fiscal deficit. Firstly, do you see the fiscal deficit target being met? Secondly, the government is saying that they are buoyant on the tax front issue. Do you think that the GST, anti-money laundering measures, demonetization, all of this will show up favorably?
So no, we are a bit worried on the fiscal arithmetic for FY19. Our best guess is that the government needs about 13.1 trillion rupees of GST collections this year, states plus center put together. And this is actually, frankly, a very difficult number to pinpoint. There's been a lot of debate around what is the break-even GST collection. We've gone through all the state budgets, we've gone through central budgets, and our best guess is 13.1 trillion is necessary. Currently, we're running at 95, 93, and you will get some seasonality during Diwali, hopefully. But it does look like we are going to be short of GST collections by a meaningful number. The second reason to worry would be the disinvestment target itself.
Yeah.
8,000 crores looks very stiff, especially if
I think they're just at around 10,000 odd crores now.
With the LIC buying that bank, perhaps that number will go up, and there's some potential transactions the government is talking about.
But we are way into there already.
Correct. So in desperation, the government could extract some more cash from its public sector enterprises, more dividends, more buybacks. All of that is possible, but it does look like a significant risk to that 80,000 crores is around. And on top of that, there is expenditure slippages. So you've seen significant announcements on welfare, on housing, and healthcare. They may not contribute much this year, but it's nonetheless slippage on the margin. So we think that either through some kind of expenditure control in 4Q, which is very challenging, or some kind of desperate revenue raising measures may be necessary towards the end of this year.
The other angle of this also is, what the markets and probably the sentiment around the elections. I mean, the government has been making quite a lot of announcements of late with regards to different sectors. They came up with the MSP. Obviously, the implementation of that is going to be key. But how are you reading into the kind of moves the government is making across sectors? Even for sugar, they raised ethanol prices. So they're sort of, in a way, taking all these measures, but implementation is key, and the reaction to that now, people are saying the MSP, once it's implemented, will feed into inflation, which will make RBI's job that much more tougher.
Right. So then you go back to the things that says there's no such thing as a free lunch.
Yeah.
Okay. And that's where policymakers have to make trade-offs. Now, I do agree with your concern that some of these measures may have come too late in the day. So announcing the MSP increase and then the 3 new mechanism of implementing that higher MSP may have come too late in the day, especially for the Kharif crop. It is unlikely that too many farmers may see, and we are worried that it may not be implemented as rapidly. But that's chicken and egg. If these were implemented, if let's say the Ayushman Bharat program, the healthcare, were very properly implemented all across the country on day one, then the amount you have to spend on it would have been much higher than you can afford. Okay, so in a way, the ramp up of these projects kind of fits the fiscal arithmetic, but it may not fit the populist arrangement of things where you would want these things to have been fully effective on day one. Okay, so it's a trade-off, and frankly, we are concerned that the government's ability to deliver on these and the monetary ability to fund all of these may not be very high.
I want to shift focus now a little bit to the markets and dwell a little more there. So up until now, it was a little more the quarter one results that came out, the earnings performance of corporate India was a positive. So it was read into with a positive light. EPS targets are on the upper side. But macro concerns like CAD, do they weigh down significantly heavy? Elections, do they weigh down significantly heavy in terms of volatility? Or you give precedence to earnings and micro indicators which ultimately direct you towards growth?
Okay, so first I agree, micro indicators and some of them are looking much better. If you look at the Lee Keqiang indicators in India, 203, electricity demand, rail freight volumes are actually moving up. The first quarter, if you strip out the banks, the BSE 500 delivered 23% profit growth. It's a great number. The problem is that even after 23, we actually saw earnings downgrades. There weren't upgrades. And we did an analysis a little while ago where we demonstrated that from a one-year investing point of view, earnings growth in itself is not sufficient to deliver returns. You need earnings beats. Okay, and if stocks are seeing earnings downgrades, then they struggle to perform. So our concern is, yes, the micro is improving, but expectations are way ahead of where the underlying is. And if I'm going to see meaningful earnings cuts through the year, then I'm not hoping for.
So market expectations from these companies and the kind of growth performances that they put in has shot up sharply.
Has run ahead of itself. Now what happens is, why it's a classic psychological problem, I suspect, is we got 40% returns in the market last year. So sell-side analysts, in order to justify recommending buys on stocks which have become extremely pricey, have pushed up their expectations. They would have originally thought maybe a 15% growth is sufficient, are now talking about 20-25% growth, because you need to justify stocks with 50 times, 60 times, 70 times multiples. And that leads to the expectations being pushed up with the market. I did another chart where we demonstrated that the earnings expectations of analysts actually lags the market. So analysts push up their estimates as the market goes up and cut it when the markets go down.
But so then that again is in relation to the environment that you're operating in. So if you're expecting a company to give you a growth of 20-25%, you have to see the peripheral support that the company has in terms of what the government does, the investment cycle, liquidity that the company has, currency, which links the two.
Yes, so you're right. So if your point is, will the macro start to hurt the micro? We think it can. Unfortunately, the data, we've done charts on this for the last 15 years. The correlations are not easy to draw. So you cannot take the current account deficit in India and extrapolate it to volumes of an auto company or for a staple company. There is no correlation between that. But it is fair to say that if you're going to pay another $15 or $20 billion to your oil supplier, then your disposable income for stuff within India has fallen by another $15-20 billion. Okay, and therefore some consumption will be hurt in the country. It will happen with a lag because people will realize over time that their net disposable incomes are falling. Companies now, for example, are saying we will pass it on. If our input costs are rising, we have enough pricing power and we will just raise prices. But again, we did this analysis. The moment you raise prices, there is an impact on volumes. Right? Your sales will slow from where it would have been otherwise. And again, these correlations are fairly robust across categories. So now the answer to your question is yes, the macro will impact the micro. It may happen with a bit of a lag. Another risk to earnings estimates. So if you were 3 months ago saying that my company is going to grow 25%, you may now have to pare that down to 20% or less. There'll be a cut.
So where does one say that value lies? In the sense, you just said that analysts who wanted to justify the highly valued stocks to go ahead and give a buy rating to them have increased and upped their growth expectations. But nonetheless, those companies were bought into, and investors like them. But there is a price to value, and investors were paying that. Is there some sense of semblance in terms of how much you can exceed in terms of paying for that company in terms of value and growth potential?
So right, so there is always this debate that look, we are paying a higher multiple because there is a recovery in growth. So then we did that math as well. We said let's factor in the growth and see if we are overpaying or not. And the best way to do that is a DCF. Okay, so we took the consensus forecast and we said, look, while I think analysts are wrong and they are overestimating the earnings power of most companies, let's assume that those numbers are correct and then reverse DCF the implied cost of equity in all of these stocks. The implied equity risk premium in Indian equities is at all-time lows today. So even after I adjust for the growth that is expected, it is a significant re-rating of these stocks. And many of these stocks have seen significant compression of the cost of capital, which is very, let's say, opposite to what's happening in the debt market. We've seen bond yields rise, yet we've seen compression in the discount rates for these companies, growth adjusted. And that's why I argue that the valuations are not in my favor at all. And you'd be very careful in chasing risk. So the other point I make is that, look, I've been cautious on this market for a while, and that's not worked for some time. But valuations are never an indicator of timing. Okay, I could have sold something at 30 times earnings, gone to 60 times earnings. But valuations are an indicator of risk, and I say this in most conversations. If valuations are rising, I need to de-risk my portfolio, which means I would avoid liquidity risks. I will not buy the small mid-cap stocks as much as I would earlier. I would graduate more towards quality companies where earnings risks and operational risks are lower as well.
So currently, we all know where the valuations are a bit stretched, though they have been coming off a bit in most of the consumption names. You have NBFCs as well, which a few of them, which seem to be a little bit stretched. So are you saying that, that be a little more cautious in terms of taking a call on whether or not this growth will surpass the valuations for you?
Correct. I do think that will happen. So look, if you take a 5-year, 6-year view, the economic cycle will drive equity. So if you are seeing growth recovery, then over time you will see Indian equities benefit from that. But equities do not always move with growth. We've overshot too much, and you need to.
So it has to come back to.
It has to come back to where the trend is on the underlying economy. And that's why I think we're not there. I mean, the market's just fallen to where it was probably in June.
So, one space, or rather two spaces, that seem to be of a lot of interest now, and on the backdrop of what the currency is doing, has been the IT and the pharma space. Now, is just the currency move enough to support the kind of euphoria in some of these stocks?
My short answer is no. Because we are seeing an improvement in growth, revenue growth for IT companies, but this frankly is a bit of a normalization from a relatively slow period.
Because up until 2 years back, no one really...
Rightly, because this growth was decelerating. And slightly flippantly, I put it to clients is, in a way, to say that IT is what you buy in India when you don't want to buy India. Okay. It's defensive. So why are you coming to India to then
if you don't
buy?
Want to make that, that extra froth on top.
So this was not true, let's say, 7-8 years ago, because IT was a growth story. Now we are not talking about growth. I mean, now the only argument for IT is defensive characteristic in an expensive market. Okay. On that count, these stocks have still become very expensive again because there are few places to hide. And if the currency is as volatile as it is, everybody is going to buy IT. I can understand that. But is this a growth sector? We are not convinced that it is.
From a long-term perspective also?
Yes.
Like maybe 5 years down the line?
Yes, so let's say if this currency is depreciating as much as it is, over time...
Because the deal pipeline seems to be improving.
Yes, but it's still not enough to drive double-digit growth. You'll go to a 9-10% maybe growth rate for the pack. Maybe one company does better than the other, is always happens. But is the Indian IC sector getting into mid-double-digit growth? We are not convinced that it is.
So more of a phase of consolidation.
It is a consolidation, and our worry is that at some point in time, the gains from the currency will be taken away by the customers as well, because they know that Indian IT companies are seeing expansion of margins. So there may be pricing pressure. So we'll see how this evolves. But from a market perspective, there seems to be a significant overcrowding in IT names at the moment. It's the only defensive people can think of.
And people are finding refuge in pharma also.
Yes, but pharma is not ubiquitous.
Yeah.
There are pharma companies that people like and some that you don't like because everybody's got their own specific issues. So you can't basket buy a pharma sector, but you can basket buy IT.
Yeah. The other one is obviously this is a big space which is in focus right now. A lot of moving parts here. Financials. You have the PSUs on one side. You have the private retail banks on one side. You have the NBFCs on one side. Housing finance companies. You dissect them and you see them. A lot of announcements, a lot of news focus in this space. How did you read into the merger announcement, the capping of the TER, and obviously private sector banks and their leadership not getting a transition into the next leg?
Right, so I'll refrain from commenting on the merger because we don't cover those three specific stocks. But that is something that has been on the government's agenda.
Just in general, the consolidation within that space.
Right, so that has been on the agenda of the government for a long time. And if this is happening, I suspect this is not the only one that they're thinking about, and may perhaps consider other forms of consolidation as well. And if you've got some small PSU banks who are on the preventive corrective action list and who can not longer lend, then it makes sense to kind of consolidate them into a larger public sector bank. Does this drive synergies over time? Does this lead to a better bank? I think only time will tell, frankly.
Because so far, I mean, the country's largest PSU bank, when the whole merging happened with its associate banks, I mean, the earnings performance just, was a complete disappointment for the markets. It's still trying to recoup from that.
Correct, but you don't know how much of the earnings was because of the consolidation and how much was because of provisions being as high as they have been for so long. You can't split out the impact of the merger yet. It's too soon and the numbers are too noisy to my mind. That said, the June quarter was the first where the PSU space did not book gross NPAs on net basis. March was a disaster in terms of gross NPA addition, but in June it was a negative number. Okay, they booked reversals more than they have booked additions, which is why the market started noticing it and started getting excited. Look, we've been calling the peak in stress for a while. Maybe it's happened. If not the June quarter, then maybe December or March with the implementation of the RBI circular, all the large NPAs should wash through the P&Ls of these banks. Provisioning will continue because it's an aging phenomena to the NPAs, but it does seem that most of the stress is now recognized, not too many more skeletons in the cupboard, hopefully.
So have PSUs bottomed out according to you? Most of them have started front-loading provisions. The fresh slippages were also lesser in some of their books.
Yes, so the fresh slippages are lower. From a stock perspective, I think they will remain volatile because while the gross NPA additions may slow down, you will see a lot of news flow around specific IBC cases. And suppose you get an announcement that in a particularly large case, the PSUs have to take 80% write-off because there's no bidder, then that's bad for the PSUs because then incrementally there'll be more provisions. So you're not at the end of a news flow cycle for the public sector banks, and therefore I think the volatility in this space will remain very high. But from a slippage perspective, if not the June quarter, then December or March, depending upon what the Supreme Court does with that case now.
So till then, would you still, put your hand on the private retail banks and say that they're still a better bet compared to PSUs?
On a relative basis, yes. Because like I said, my investing mantra has been to avoid as much risk as I can. Okay, and at these private retail banks, the earnings risk is obviously much lower than it is at any of the other financial institutions. And that's why it would still remain my relative preferred pick.
And what do you make of this hula hoo around NBFCs? And do you feel that the debt market panic is sort of seeping into the equity side as well?
I think it's too early to tell. We shouldn't deny the possibility that if the credit markets were to indeed get tighter, it's only the first day we will know over time whether it does, then it will have a real impact on the borrowing ability of many of these NBFCs. Because let's say, just as out of sentiment, if mutual funds, suppliers of money start asking for a higher yield from all of these NBFCs, even if they're AAA rated or not, then it will have a real money impact on their P&L. Is it going to happen or not? I think we'll figure out over time. It's just too early.
Because a few of them, and I wouldn't name them because you wouldn't be able to talk about them. But yeah, the creme de la creme of this space I mean, valuations were steep.
Yes.
I mean, but their business prospects were equally good, and that's why the markets gave them a thumbs up. But now, I mean, does it look a little bit shaky? I mean, uncertainty creeping in?
Look, I'll make another comment here. When you are pricing in continued high growth and then paying a very high multiple for the high growth, you cannot afford a slip from a stock perspective. So if you see any miss, whether it is on the growth, whether it is on the ancillary issues, the stocks do take a beating. It happens all the time. Okay. Are the NBFCs in that spot yet? I don't know. It looks like, given they've crashed today. But will we really see an impact on growth? I think we'll figure out. If the credit markets do not normalize, then yes, their margins and growth will come under pressure, which is bad for very expensive stocks.
What happens to liquidity then?
So I'm hoping it doesn't, because those are the dire scenarios for all of us. I mean, however bearish you are, you don't want that kind of a play in markets. But look, one could argue that there's not too much space for money to go to. It's either debt or equity. In India at the moment, gold's doing nothing, real estate's doing nothing. So if not in debt, deposit rates are too low. In equity, then.
But there are also the timing of it. Like, does equity warrant investments at this time, or does debt warrant investment at this time, or another asset allocation?
Well, I can only give you my personal experience there. When I was trying to subscribe to an FMP last year, the bank returned my check because you couldn't raise the money for the FMP. Now you're getting a new FMP launch every day. Why? Because even with a 3-year lock-in, I can now make 8% post-tax. Inflation is still 4. So even if that goes up, I'm locking in a 3% real return for 3 years. Why do I need to take equity risk at expensive valuations? So today's issue will lead to some markdowns in credit funds NAVs. Hopefully that doesn't get worse. But even post that, the returns on debt compared to inflation are very attractive at the moment.
All right, interesting. Anything in particular that you've studied deeply and you feel that pocket deserves attention and has incremental value?
Well, we struggle actually when clients ask us, what stock do you think will deliver 30% returns from here in 1 year? Because we don't have a very big list, frankly. We do think there is significant downside to the market, and I need better prices to get super excited about the market. On a relative basis, we think the rural stocks will do better. One of our arguments is that depreciation of the rupee actually helps transfer consumption from the urban consumer to the rural producer. Okay. Why? Because many of the inputs of the farmers are fixed. Water is free, power is free, fertilizer is fixed. But the top line, the agri price, is partly linked to the dollar. Many commodities don't trade to the MSP, but to the export or import price. Okay. So farmers are likely to see an expansion of top line, whereas the costs are fixed, and therefore an income growth is likely in rural India, which is supported, let's say, by whatever the government is doing on welfare. Okay. So on a relative basis, I think the rural stocks or the rural focused names could possibly be worth looking at. Within that, we are actually not too excited on the staples.
Okay.
The argument I've made is that Indian staples have gotten very expensive, but more importantly, Indian staples are re-rating while global staples are crashing. Right? And this disconnect is actually very rare. If you look at the historical charts across sectors, Indian sectors tend to move in line with the global sector flow as well, just at a premium. But for it to go divergent is very rare, and that's why we have gone very cautious on staples. And the other thing is, people think of staples as defensive, but this year the correlation of staples with markets has significantly gone up. So is it a defensive as well? I don't know. So within the rural space, we'd be slightly lighter on the staple side, but yes, the two-wheelers, maybe the cement makes sense as well.
You think it does at this point?
The cement, we are convinced that the volume growth will come. Okay. Whether the margins will come or not is
wait and watch.
Yes, we'll see.
All right. Sanjay Magim, it was a pleasure chatting with you. Thank you so very much for joining us.
My pleasure being here, Navina. Thank you.
Thank you.